Welcome to the Deep Dive, where we cut through the noise and get straight to the insights. Today, we're taking a deep dive into the Q1 FY26 financial results of Orient Electric Ltd, a major player in the electrical and consumer durables sector. You've armed us with a stack of detailed reports, everything from their earnings called transcript and financial statements to investor releases and a press note. Our mission is clear: to distill the most important nuggets from these documents, helping you understand not just the raw numbers, but the compelling story behind them and what it truly signifies for the broader market. Get ready for some genuine aha moments.
Precisely. This deep dive will illuminate how Orient Electric navigated what was undeniably a challenging quarter, highlighting both their resilience and their strategic agility. We'll meticulously unpack their financial performance, delve into segment-specific trends, and crucially, examine the company's proactive initiatives in product development, market expansion, and cost efficiency. What's truly fascinating here is observing the intricate dance between external environmental pressures and their internal strategic execution.
Okay, let's unpack this. Despite what sounds like a tough environment, Orient Electric actually reported some rather interesting overall figures for Q1 FY26. What are the headline numbers that jump out immediately?
Right. The company reported a total revenue of 769 crores, marking a 1.9% year-on-year growth. Now, while this was below their initial expectations, they had a more ambitious target. It still represents a tempered performance that managed to outperform the broader industry trend. On the profitability front, profit before tax, or PBT, saw a healthy increase of 22.8% year-on-year to 24 crores, and profit after tax PT stood at 18 crores, up 21.8% year-on-year.
So a modest top-line growth, but a really strong improvement in profits. That's striking. What about their efficiency metrics? How did they manage to boost the bottom line when revenue was sluggish?
That's a critical question. Gross margins remain stable at 32.6%, comfortably within their target range of 32-34%. But the real story is in the EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It saw a robust 15% year-on-year increase to 46 crores.
15%. Wow.
Yeah, and the EBITDA margin expanded by 68 basis points. That's just over half a percentage point to 6.0%. This margin expansion is a significant takeaway, demonstrating underlying operational improvements and, disciplined cost management, even in a difficult revenue landscape.
Okay, here's where it gets truly interesting. You mentioned a challenging operating environment. What exactly were the specific headwinds they faced this quarter? What made it so tough?
Well, the primary challenges stem from unexpected climate shifts. Really quite unpredictable. Contrary to the intense summer of the previous year, India experienced much milder temperatures in 2024, starting in the southern states and progressively spreading across the country. And then adding to that, record-breaking rainfall in May effectively cut the summer short.
Ah, okay. So a double whammy.
Exactly. Dramatically disrupting seasonal sales cycles and inventory planning for their key products like fans and coolers. There was also a brief period of market softness due to heightened geopolitical tensions, which temporarily affected overall sentiment.
So the weather essentially pulled the rug out from under their summer sales season prematurely. How did the company respond? How did they demonstrate resilience amidst these powerful external factors?
Well, Orient Electric focused on agile execution, deepening their market penetration, and strategically aligning their product portfolio with evolving consumer preferences. They basically doubled down on their long-term focus on premiumization, innovation, and channel expansion. These proactive steps allowed them to maintain momentum, particularly in segments less exposed to the immediate weather impact. The management is quite clear in viewing this as a seasonal impact, not a structural issue for the industry.
Right.
Which is a very important distinction for investors.
That's a critical distinction. What indicators give the management confidence that this is merely a blip due to weather, rather than a deeper, potentially permanent shift in consumer behavior or market dynamics for products like coolers?
That's a good question. Their confidence seems to stem from several observations. Firstly, the demand for cooling appliances typically rebounds pretty strongly with the return of hotter weather. It's quite cyclical. Secondly, their continued success in premium energy-efficient products suggests consumers are still investing in quality rather than pulling back entirely.
Okay.
And thirdly, their strong performance in other segments like lighting and switchgear indicates a diversified demand base.
Right, not just reliant on seasonal stuff.
Exactly. Not solely reliant on seasonal products. They're essentially betting on a return to normal weather patterns and consumer spending habits.
Let's pivot to their strategy, which they often highlight. They talk a lot about premiumization and innovation. Can you give us some concrete examples of how this played out in Q1 FY26, especially given the challenging backdrop?
Absolutely. In the lighting segment, for instance, value-added products consistently contributed 55% to their overall consumer lighting business,
Hmm.
which shows they're aligning with established industry leaders in that space.
Mm.
For fans, they didn't just add new products. They launched a premium range of BLDC, that's brushless DC fans, under a Tech Meets Design campaign. These are highly energy efficient, and their sales grew over 50% year on year. That's significant growth.
50%. Wow.
Yeah. And what's more, new product developments, or NPDs, now contribute more than 20% to primary sales. And their premium product mix has improved by almost 250 basis points year on year, now accounting for a significant 30–35% of their ceiling fan sales.
30 to 35% from premium fans. Okay.
Exactly. And even in heating appliances, they innovated with new premium square-shaped storage water heaters, packed with enhanced features.
That's a remarkable number of new products and a significant shift towards premium offerings. But great products are only half the battle, right? How are they ensuring these premium offerings actually reach consumers and get noticed in a crowded market?
This brings us to a crucial part of their go-to-market strategy. They've invested significantly in retail experience programs designed to enhance customer engagement. Initiatives like Mission Orange and Project Spotlight aren't just about visibility, they're about creating experiential retail pushes.
Experiential. How so?
Well, these programs allow customers to touch, feel, and see live demonstrations of the products, which is particularly effective for premium appliances where you want to show off the features and design.
I see.
Mission Orange alone, for example, expanded their visibility to over 1,200 new outlets this quarter. This direct sensory experience helps justify the premium price point and showcases the innovation effectively.
So beyond just the exciting product innovations, how is Orient Electric actually expanding its overall market reach and building brand loyalty across their entire portfolio?
Their channel strategy, especially their direct-to-market or DTM approach, continues to deliver significant results. They added approximately 1,800 new retailers under the DTM network this quarter.
1,800 new ones.
Yes. And the core strategic advantage of a direct-to-market model in a sector like consumer durables is that it enables them to have greater control over margins, gather faster feedback from the market,
Right.
and build a stronger, more direct brand presence at the point of sale. Interestingly, even DTM states saw marginal growth despite the overarching seasonal headwinds.
Okay.
Their e-commerce channel also saw robust traction across categories, and they're now strategically participating in quick commerce platforms.
Like the grocery delivery app.
Exactly, like Blinkit and Zepto, to enhance customer convenience, which really validates their digital-first approach.
And what about brand building, the big campaigns we often see? How are they making sure their brand resonates with consumers?
They invested strategically in brand building during high-impact periods like the IPL season.
Yeah.
Big visibility there. These campaigns were designed to reimagine fans in the context of modern homes, emphasizing cutting-edge technology, diverse designs, and premium finishes, including over 40 color options for their BLDC and premium fans.
40 colors.
Yeah, quite a range. Now, while these investments did increase advertising costs around 5.5% of revenue this quarter, compared to a typical 4 or 5%, they are viewed as a foundational investment.
For the long term.
Exactly. For long-term margin expansion and bolstering brand equity. They've also broadened their digital reach, utilizing social media influencers and contextual platforms like Spotify, Uber, and MyGate.
Interesting places to advertise fans.
Yeah, the smart move to capture modern consumer attention where they actually are.
Let's break down the performance of their different business segments then. How did the electrical consumer durables, or ECD, segment fare, especially with that significant weather impact on fan sales?
Right. The ECD segment, despite the direct hit to fan sales, remained stable overall with revenue at 545 crores. Fans reported a muted single-digit growth, which is understandable given the climate challenges.
Okay.
However, coolers were significantly impacted by the weak summer, experiencing more than 40% degrowth.
Ouch, over 40% down.
Yeah, that was a major drag on the segment. On a brighter note, water heaters, perhaps benefiting from a longer winter season or simply strong new launches, witnessed double-digit growth.
So coolers were clearly the segment that suffered the most from the weather. What about the lighting and switchgear business? Was that a different story?
Absolutely. This segment emerged as a strong growth driver, delivering approximately 7% growth overall. Much better picture there. The B2C lighting business, in particular, outperformed the industry with single-digit growth in value and impressive double-digit growth in volumes.
Double-digit volume growth. Okay.
Yeah, significantly aided by new product developments and strategic distributor expansion. The switchgear and wires category also registered accelerated performance with high double-digit growth. Really strong there.
Wow.
This segment also saw notable success in its B2B lighting business, executing key street lighting and facade projects. They mentioned places like the Chhatrapati Shivaji Maharaj Museum in Maharashtra and Sana Temple in UP.
High-profile projects.
Definitely. And they're quite confident in sustaining this growth with a healthy pipeline of new inquiries.
Okay. Beyond top-line performance and segment specifics, what's happening internally to optimize operations and financial health? Are there any internal initiatives making a difference?
Yes, Orient Electric has a significant transformation initiative called Project Sanchay, which delivered savings of 9 crores in Q1 FY26 alone.
9 crores just from that project.
In one quarter, yes. This really underscores their disciplined execution and focus on cross-functional synergy to achieve tangible cost efficiencies. And if we connect this to the bigger picture of their financial health, their working capital days stood at a healthy 25 days.
Very efficient.
And they closed the quarter with a net cash position of 72 crores. This indicates robust financial management and strong liquidity, providing a solid buffer. The company also announced the appointment of Deloitte Touche Tohmatsu India LLP as their internal auditor for FY25-26.
A big name.
Indeed, which signals a clear commitment to robust internal controls and good governance.
I also noticed a mention of some regulatory challenges in the source material, specifically concerning GST. What was that about, and how significant is it?
Yes, that's an important point to clarify. The company received demand orders and show cause notices from various GST and central excise departments, totaling over 63 crores.
63 crores? That sounds substantial.
It does. These concern alleged issues like the import of goods at higher GST rates or misclassification of goods. However, based on the legal advice they've received, the company firmly believes it has a strong case on the merits for all these demands.
So they're fighting it?
Yes, and consequently, they have not made any provisions against these amounts in their financial statements, which suggests they are pretty confident in successfully defending their position.
Okay, interesting. So with all these dynamics at play, what does this all mean for the future? What's the management's outlook for the coming quarters, especially given the challenges faced in Q1?
Well, the management remains quite confident in the strategic levers they've put in place and their ability to navigate external factors. They seem pretty upbeat, actually. They are optimistic about a demand revival in the coming months, anticipating tailwinds from the festive season build-up in Q2, especially with Diwali being earlier than usual this year.
The early Diwali effect.
Exactly. And a broader expected improvement in consumer sentiment and spending as the economy stabilizes, hopefully.
They also mentioned something about new star ratings impacting fans in the future. Can you elaborate on that? What does that mean practically?
Yes, a star rating ratcheting for ceiling fans is expected to come into effect on January 1st. What this means is that existing star ratings will essentially be downgraded. For instance, a 2-star fan will become a 1-star, and a 1-star will become a 0-star.
Oh, okay, so standards are getting tougher.
Precisely. This regulatory change will likely lead to some price or cost increases for manufacturers, which will then probably be passed on to consumers. The company is actively preparing for this transition, adapting their product portfolio and pricing strategies to minimize disruption and ensure compliance. It's something they have to manage.
And what's their long-term vision for the brand, beyond just navigating the next few quarters? Where do they see Orient Electric going?
Their long-term objective is pretty clear. Achieve double-digit EBITDA margins. That's a key financial ambition. They're emphasizing that they are not striving to be a value-for-money volume brand, but rather a consumer-centric premiumization brand.
So focusing on higher value, not just volume.
Exactly. Focusing on solving consumer problems with innovative higher-value products and building a well-balanced portfolio across their segments. This strategy, they believe, will yield sustained gains in market share and overall value creation. They're also actively exploring export opportunities for fans and switchgear while keeping a strong focus on domestic capabilities for their wires business.
What a deep dive. We've really peeled back the layers on Orient Electric's Q1 FY26 performance, seeing how external pressures like the weather met internal resilience and strategic execution. From innovative BLDC fan designs to their direct-to-market network, it's clear they're playing a very deliberate, long game, aiming for sustained growth and premium positioning.
Absolutely. While Q1 presented distinct seasonal headwinds, no doubt about that, the underlying strategic focus on premiumization, cost efficiency through initiatives like Project Sanche and proactive channel expansion truly positioned them well. The crucial challenge now lies in how quickly the broader market sentiment and seasonal demand normalize, allowing them to fully capitalize on these strategic efforts.
So, for you, our curious learner, here's a thought to mull over. In an industry so heavily influenced by unpredictable factors like weather and geopolitical shifts, how do companies like Orient Electric build in enough strategic resilience to not just survive, but continue to innovate and grow without getting blown off course? And what does their strong and clear focus on premiumization truly signify about the evolving demands of consumers in rapidly developing markets like India? We hope this deep dive has given you a significant head start in understanding the complexities and fascinating dynamics of the consumer electrical sector.